everyone. We're happy to see you here online, and I'm happy to introduce you Dr. Andreas Bickel, who is Chief Investment Officer of Blackfort Capital, based in Zurich, Switzerland. Andreas, hi, how are you?
Hi.
According to the latest inflation news, how do you think, what is your take? Is US inflation transitory or not?
That's actually an extremely good question. Yesterday, the CPI figure showed that the inflation is decreasing, and we had the narrative that deceleration and disinflation. But today, so 24 hours later, we have the producer price inflation data of the US, which showed exactly the opposite, that the inflation data is accelerating. And the funny thing is how the market takes it. Yesterday, we have seen a rally in treasuries and followed by a weaker dollar. And today, we see exactly the opposite. So treasuries are going down or yields goes up, and the US dollar is strengthening. Therefore, the honest answer is nobody knows, but I would say inflation is sticky, will stay around, but most likely we will not have hyperinflation, and the Fed is somehow right with its narrative to say that inflation is transitory, but I would say transitory until late next year.
Okay, that's interesting. Thank you. And in your opinion, equity markets have risen sharply. Are they now overvaluated, or how do you think?
That's a very delicate point and very surprising answer, because we are, at least in Europe and in the US, at new record levels almost on a daily basis. As we speak, the DAX, as an example, has reached its new record level. Maybe it will even go above 16,000. Similar picture in the US, although inflation data is somehow sticky and high. But the valuation is lower. Why? Because we have seen a tremendous Q2 earnings season. Therefore, in Europe, the valuation has sharply decreased. Similar picture in the US. So now, although we have much higher valuation, much higher market prices, the valuation itself is much lower. So basically, the US is now at the 21 forward-looking PE ratio, while it was before the earnings season at 26. So from very expensive to expensive. Similar picture in Europe, but Europe is much cheaper than the US. On the other hand, for the first time since years, Europe has growth. So the short answer to the question is the two developed markets are definitely cheaper than 3 months ago. The picture in Asia is more complicated, in particular in China, where we see a deceleration of growth. There we must argue markets are slightly higher valued than 3 months ago.
Okay, fine. And in the equity space, where actually to allocate based on all your outlook?
So based on what I've just said, it is probably fair to allocate some money to European equities. That's the first time since 2009 that I recommend to allocate to European equities, but don't underweight or don't sell your US equity exposure. Year to date, both markets have similar returns, although once more, the US market has slightly outperformed. Yesterday, I came across an interesting riddle. Which market, how many times has the US market in the last 12 months beaten global equities? And the answer is 12 times in a row, so every time. I expect the US market continues to perform well. I expect that European markets will, for the time being, head up with the US. And I would, as a mean reversion trade, add some money to Asia, which has corrected sharply. And from the terms of where to allocate, I would rather go with cyclicals and with banks and insurance, and not with tech or long duration stocks, because US yield is, as we speak, rising and approaching 1.4% in the 10-year.
Okay. Okay, Andreas, thank you so much for this short presentation, and we will see you next time. Thank you.
Thank you.
Bye.
See you next time.